All right, what's up, guys? If you guys haven't already watched the video with my boy Houston, who's the life insurance king, we already walked through all the benefits and everything. This video is going to be an actual live illustration. I'm going to be going through a policy myself with him. But yeah, I'll let him take it away. This is kind of this isn't really an example. This is like, I'm going to actually follow through on this, but just so you guys can kind of see the potential that you guys have, if you guys want to get into this infinite banking concept or just any type of life insurance. Right now, we're going to be covering more so the IBC, right? The infinite banking concept type of insurance.
Yep.
Cool, cool.
Yes, sir.
Awesome. Cool.
Cool.
So let's get
So
into it.
first and foremost, thanks for having me, Miggle. And then secondly, let's just hop right into this, so pretty much what we're doing right now is we already have your personal information and stuff on the first section of this illustration. Now we're going to be trying to design this policy. That way you can have the maximum amount of cash value year one without having an actual mech, which would pretty much cause a taxable event. So what we're looking at here is total annual premium. So this is going to be like what the goal is to be putting in yearly. Now, right now we have pretty much $12,000. Now, would you say like the goal that you would want to put in, or do you want to put it higher? Because that's not the minimum, that's the goal. Like, for example, the minimum on something like this is probably like 140, like right around like 140 a month. So, but if you wanted to, like, you can't put much more than this. Like, I think the max you could probably put in on something like this is like 14,000 a year. So if you did want to make it so you
Really?
have more room, then we would want to put this up a little bit.
I would definitely want some more room. My biggest concern though is like I would want to know what the minimum is because the whole reason why I'm doing this is like I mentioned earlier, if I have too much money in my
Yeah,
bank account, I'm gonna fucking spend it on stupid shit. So like I want
yeah.
to invest, have a vehicle that will just automatically take my money and invest it into here. But like I just also want to plan like let's say my business or my other cash generating income like is a little bit lower. I just want to make sure I'll be able to, without a doubt, make the minimum because as I told you, I'm taking over a cash out refi on a home, so like that's gonna be like four
Yeah.
thousand a month. So I definitely plan on doing more than 12,000. I would say
So
honestly that would probably be the minimum I want to hit.
let's do this. Let's put it at 18 for now. We'll look at what that minimum looks like. We could always go back and adjust it. Nothing's final right now. We're pretty much just playing around with the numbers to like make it so it's what we want to see. And then once we get it to where we want it to be, where you're okay with the minimum, you like the maximum, you like the actual cash value on year one on the what it's projected to do, then that's when we'll move forward. So pretty much what we're doing right here is we're avoiding mech. So that's pretty much a taxable event. We don't want any taxable event within the first 30 years. We're doing a 90-10. The base is pretty much your life insurance. So like your actual life insurance will be when you're doing actual infinite banking, you want the least amount of life insurance and the most amount of paid up premiums. So pretty
Hmm.
much it's like a one-time paid premium. That's what your LPUA is, where pretty much that's going to be not going towards your death benefit. That's going towards your cash value, right? And then
Cool.
you have to get it to a point where you can't do all 100% cash value because then you're creating a taxable event. So we play with the numbers from here. But first we got this set up here. So let's view what this illustration looks like. And then we can come back and adjust from there if it's not what we want to see.
Cool.
So let's see here. Pulling up that illustration. This could take sometimes a little bit. All right. So let's go here. Additional information. All right. So what we're looking at here, um, minimum monthly premium would be 199. This is like the minimum to keep it afloat. This is like where like the target, like your target goal for like your first year would be like 1500. Um,
Hmm.
and then you can see the actual policy amount here, the actual life insurance from this from the base itself is only 44,000, and then you have that 30-year rider that's added onto it, which is giving you that extra there. So if we look at the actual, we look at what we're putting into here. So we have age year one right here. So max lump sum. So your actual death benefit, what we're looking at, monthly premium is right here. So this is for, oh wait, this is for the accelerated death benefit. This is the wrong section. So pretty much accelerated death benefit right here, just so you know what this is if you were to develop anything chronic, critical, disabling, cancers, heart attack, and stroke, this is kind of what you would have access to. But let's actually take a look at the actual insurance policy itself from what we're looking at, which is right here. So we got year one. This is the premiums that you put into it, 18,000. And then the cash that you're gonna have available right here is 15,750. So a good like
Nice.
math equation that you want to be able to do on this is what you want to look at here is, well, we're gonna go and we're gonna take this number, the 15,758, put it in our calculator, 15,758, and we're gonna divide it by the actual premium put in, which is 18,000 a year. You're looking at about 87% of your cash value on
Dude,
year
hell yeah.
one, which is pretty good. And we're looking pretty good there, so that's pretty solid. And you can see your death benefit is already at 411, and it just
So
grows
that's how
as
much
the
I would
time
get.
goes on if
Is
you
that how
passed
the for
away.
the death benefit if I passed away? So I basically put 18K in year one, but if I died, I get like almost half a mil. Is how that works?
If you paid your first premium of $1,500 and God forbid something happened, like the next like week, whoever your beneficiary is, your family, your girl, your mom, your dad, whoever, they would get that amount, the
That's
411,000.
crazy. Cool. That's
Yeah.
dope. Hell yeah.
So then let's fast forward. Let's say you did it for 20 years. Let's say you did till you're 50, right? 50 years old. You would have put in 396,000 into this policy, and you would have access to about 600,000 with a $1.4 million death benefit,
Damn, that's pretty wide.
which is pretty crazy. So like this strategy is a strategy that a lot of the elite families use, the Rockefellers and things like that, to be able to pass on that generational wealth. Because I mean, you could picture the numbers. Imagine if you're putting freaking 5K per family member into something like this, right? And something, and you start on year one of their life and they go, let's say, to even if they live to 65, I mean, you're gonna have a huge death benefit right here, right? So it's like right here as well, let's say to 65 for you, you have
Hmm.
you have your actual premium, which is 568. You have access to 1.35 million with a $2 million death benefit.
That's crazy. That's sick.
Yeah, yeah. So yeah, it's kind of like the benefit of it. So that's kind of it in a nutshell. Now, what we can do now is let's play around with this number a little bit and see what we can do, if we can get even better. So we're gonna go here and let's try 9, 9, and let's try 91 and see what that looks like.
Should we be checking the avoid Mac options or?
Oh shit, yeah, you're right, you're right. I definitely need to click that. So we'll let it load. We'll let it load. Skipped a little spot there. Let's go back there. Yeah, so we definitely want to avoid the mech on that. So 910, avoid mech, 30 years. Okay. So let's see what this looks like. So go here. So 181 is the minimum, 1,500 right here. Yeah,
Question
so you
about the
want
minimum monthly payment. So if I'm only making the minimum, um, does that, how does that
these
work?
projections, these projections are on if you're making the 1500.
Mm-hmm.
They're not on the minimum it so to speak.
Yeah, yeah,
But
yeah.
the
Gotcha.
yeah, but the minimum would be it would be a little bit different than these projections. Probably a lot
Yeah.
bit different,
Yeah,
you know.
definitely it'd be a lot different. But I'm just curious, is that if, let's say if I was just making the minimums, that would still go towards like the available cash value I have, right? Or is that just to like keep the policy open, or how does that work?
So yeah, so the actual minimum itself, this right here is to keep the policy alive so you don't actually have a lapse and then lose the policy itself.
Okay,
Yeah.
gotcha. So
So
if I'm
go
making
ahead.
more than 181, then like let's say I put in 200 or whatever, the extra cat, $20, whatever would go towards like the cash value, or how would that work?
Yeah, exactly. So this is just to keep the policy like alive. Um, this itself, I would have to double check on that, but I'm pretty sure this itself doesn't really build much cash value. That's like the just kind of like what's funding the base. Remember when we did the
Mm-hmm.
9 and the 91? This is like the base pretty much,
Gotcha, gotcha.
which is
Okay.
just keeping that policy alive for you.
Mm-hmm.
So we're looking here at this, remember we just did this right here. So now we're looking at, you put 18,000. Now you look at your net value is a little bit more. So technically now you have 15,924 divided by 18,000. You're at 88%, which is pretty damn good.
Mm-hmm.
Um, year one. And obviously, we're gonna keep playing around with this to see if we can get it even closer. I believe it'll mech out once it gets to, like, if we tried like 7, let's try 7 and 93. See what that looks like for you. That might mess it up, but we'll see. It'll let us know if it's not possible.
So as we decrease the base, that just means we're having more cash value available to loan against. Gotcha.
Yeah, exactly. That's the whole objective here is to have that cash value. Okay. This is the accelerated death benefit. This is the actual rider itself. Okay. So now we're at 16,185 divided by 1,800 or 18,000. We're at 89.9%. Like
90%.
that's probably the best we could get it. I mean, we can try
Uh,
a little bit. We'll try one more, see if it makes it out. But yeah, that's the goal because like as you can see, this is where like a lot of like agents can fuck you over because like if they're not getting like as close as you can to that, they're pretty
mm,
much just
they just
they're
keep.
they're they make the money on the base. Like
Gotcha.
that's where their commission comes from. So if they like, oh, we could only put you 40%, get you 40% of your
It's
cash,
just like
they're making like
fuck you.
40% fucking
Yeah.
yeah, exactly. Um,
Oh wait, avoid the math.
yeah. A lot of oh shit, yeah, yeah, yeah. A lot of agents are not looking out for your best interest, let's just say that. Okay, look at wait, actually no, it's because I probably didn't have the mech on there. I think it's not gonna work, but if it does, let's see. Yeah, see?
Yeah. Gotcha. So the best would be seven
So it
seven
it
ninety
mech'd it.
three. Gotcha.
I mean, we could get into decimals if we really wanted to, but it
Nah.
already was at
Yeah.
89.999.
Yeah, it's literally
Like
as
it's
close as it
like
gets.
Like
Okay.
you can get pretty nerdy on it if you really wanted to, where you're
Nah,
just like,
I'm
oh,
cool at
well, can we try like
7%.
7.23?
Yeah, no, it's cool.
Yeah, so
No, I'm down to move forward on this policy, and thanks for um being very transparent on this. I didn't know that the base versus the percent LPUA was that's where they're trying to like most insurance agents are trying to like fuck you on.
yeah. Well, a lot of policies, like if you get in a basic policy where you can't even design it and people will sell it as like a whole life, like the good thing about Lafayette, you could actually design it to like a decimal point to like really help out the individual.
Mm-hmm.
So a lot of these agents are going to selling these infinite banking products and they're not even like able to change anything. It's like already a pre-made template that's like, oh,
Yeah.
okay, like they get 60%, the agent gets 40%, or they get 65, the agent gets 35, whatever it might be. So
Okay.
yeah, so this is pretty much what we're looking at here. 1,500 a month is the goal. 151 a month is the minimum on that. Is that, do you want to, we can change that around too. Now that we know like the actual percentage there, like we can put it back down to 12,000 if you want. So
And the thing with these policies too is basically once it's set, you can't really change it, right? You just have to create another like policy, or is that how it
yeah,
works?
yeah.
Gotcha. Damn,
Yep,
so
that's exactly how it works. And actually, I just realized something. I think if we go lower this way, I think it lowers your actual the maximum that you're allowed to put in. Because right now it says the maximum is only
16 grand.
16,300. Now
Gotcha.
let me put this back. Let's try one more thing here real quick. Let's try this back at let's say 9 and 91. Let's see what that looks like. Because I think that's what it has to do with it as well. So it's pretty much what we're doing is we're just playing around with these numbers to get it like what we want it to be.
Mhm.
And yeah, dude, if whatever agent you're working with isn't doing this for you, just run, hit up Miggle, get my information. I'll help you guys out. Um, okay, no, I guess it doesn't have anything to do with it. So these are the rider options. So the maximum allowed premium per year, minimum 120, first year premium 500. Okay. So the initial monthly premium, so the goal on this policy would be to do a $1,500 a month for the year. So pretty much the PUA rider, which is the one that's allowing you to put all this extra money into it, because
Mhm.
it's pretty much a PUA is just like a insurance that can be added. And it's pretty much just allows you to put in more cash value, like without like going into super details on it.
Okay,
But
gotcha.
yeah, you can Google what it means. Like here, let me see. Let me Google this and give you like the exact definition, just so we have it on video here. Okay. All right, and life insurance base refers to the sum of premiums paid to date, while PUA stands for paid up addition. Paid up addition is a type of whole life insurance coverage that can be added to a traditional policy to increase the death benefit and the cash value. A PUA can be purchased using a PUA rider or dividend earnings from the policy. Once purchased, they are permanent and do not require ongoing premium payments. So it's pretty much just something that you can put into it, but it's not required to keep paying it, if that makes
Okay.
sense.
Just like additional,
Like,
like optional.
yeah, exactly. So these are really your premiums right here. The 135 and the 36 a month. These are like your actual premiums that you're required to pay to keep them alive. And then if you look at this, the PUA rider is the 1,300 a month that you're able
Mhm.
to put into that.
Gotcha. Okay, cool, man. Well, I mean, I would say for this, ideally, what I'd want to do is just do like total minimum required monthly. I'd probably set so if you go back to like the annual base what or the what was it the annual no go back to the second tab because we put like 18,000 as the annual. I want to set it just to 12,000 and then if I want to
Open a new one, we can.
yeah, I could just open up a new one right later. Just because I want to make sure this one's safe and I'm good to go. And this would be for like
Cool.
7 and 93.
Yeah. All right, let's see what this looks like. Cool. Let's go here. All right. So let's look at the actual what we're looking at here. Oh shit, dang it. I didn't mean to click that again. I wanted to look see if I missed something real quick because I noticed that the actual premium wasn't like a even 12,000, so I wanted to see on here. Oh yeah, we had it at 12,000, but I think it's because the way we set up the base. All right, so you're pretty much your premium. 12,197. The net cash value projected to be 1080. Let's do the math on that. So we'll take the 10,824, divide that by the 12,197.
Puts us at like 89%.
Yeah, pretty much right at 89% right there. Okay, and then that's pretty much where we want to be. I mean, honestly, anything above like 80% is considered a good policy. So 89 is pretty solid. And then if we look at your actual what's required here, we're shooting for 1,000 a month, with 121.81 as the minimum there.
Okay, cool.
Cool.
Well, yeah,
Sweet.
let's wrap this thing up and get it done. I'm excited.
Cool. So yeah, so before we hop into there, we could probably end the video because then we're gonna have to go into all your personal information, and I'm sure you don't
Yeah.
want everyone to
Give
know all
everyone
that.
personal shit. Cool. Awesome.